Ladies and gentlemen, I am JC Parets, and I am joined by my man, Steve Strazza, and we have a special treat for you today. Market breadth has been a big topic of conversation, just in general, talking to traders. You see it in social media. Everybody's talking about it. And Strazza and I can confirm to you that the man, when it comes to market breadth, the guy who inspired a lot of the work that I do personally, Steve will tell you the exact same thing as Mike Hurley. And when we're talking about market breadth, we're often saying, hey, Mike would say this, Mike would say that. But you know what? Today we have him here with us. Ladies and gentlemen, Mr. Mike Hurley. Bring him out. Bring him out.
Hey, Mike.
Thank you so
Mike?
much for the warm welcome. I really love being here with you.
It's true, though. When it comes to breadth and cycle analysis, you're a legend, my friend. We're just lucky to call you our friend.
No doubt.
The luck is mine, truly. It really is.
No, seriously, and we have a lot of fun around here, Mike. We try to have a good time. We do a lot of joking around. We do a lot of educational stuff. We like to learn, but at the end of the day, we're here to make money in the market. Mike Hurley, folks who don't know, guys, you are in for quite the treat. Mike Hurley, winner of the Lipper Award in 2008. Do I have that right? Right.
Sir.
So best mutual fund manager in arguably the most difficult year ever.
I was very fortunate, JC. As you know, if there was ever a year you wanted to win the Lipper, it was that year. And my long short fund, which had a 5-letter ticker, finished the year up. And I was pretty darn proud of that. So thank you for mentioning it.
Incredible.
That speaks for itself. So listen, we're here to talk about cycles, and we're here to talk about the market of stocks, which is something that's near and dear to my heart. As somebody who inspired a lot of the work that I do, we're coming in hot. Me and Steve, we going questions. We got no answers, no answers at all. A lot of questions.
We'll make them easy ones.
Yeah, I'll throw you some alley-oops, but we're gonna bring in some tough ones too. Strazza, do you want to set the stage? You got a little phone call from Mr. Mike Hurley recently. What happened there?
I did. Well, the truth is, a lot of our breadth and market internals work that we do at All Star Charts is modeled after or built after things that Mike has done. So that makes it easy for us to have conversations and discussions with Mike about breadth. So he called me, 3 or 4 weeks ago, Mike, now?
Gotta be a month. Yeah. It was pretty early in this cycle.
And he just asked a simple question. He said, do you think that this is now a new cycle, right? After the Q1 sell-off into the April lows, did we reset? Is this a new cycle? Should we think about it as the very early innings and early stages of a new bull run, or the middle to later innings of an existing bull run off of the 2022 bear market lows? And I thought that was a really fascinating question. And honestly, Mike, as you know, JC wouldn't even let us talk before this. So I have no idea where your head is at today, 4 weeks later, because you use price as confirmation. So I think it'll be great to get into. And I brought along one chart.
I didn't let you talk. It's just always better the first time, right? So we're going to have this whole argument and then we're going to record it? No, let's talk about it and let the people see this is real. We're not this is like some scripted video. We're here talking about the market. Let's go.
So this is it. This is the chart. Let's set the stage. All this is showing, there you go, is cycle analysis, right? So we have a COVID crash or a COVID bear market back in 2020, and then we get a new, initiation reading, what we call a breadth thrust, which tells us new bull market is underway. You see those circles off the 2020 lows, new bull market. You get some really nice forward returns after these readings. It's just the percentage of new 1-month highs in the S&P 500. You saw something similar after the 2021-2022 bear market. Nice breadth thrust off the lows, a big base, nice rounding bottom reversal, off to the races. Now the question is, what was April, right? What was the tariff sell-off, the trade war sell-off that began back in February, March of this year? It resulted in 20% correction, and we got a pretty standard initiation reading. We can measure these in different ways. Again, we're doing the 1-month highs here. So that's the question we're asking today, right? Is this a new cycle? Are these brand new readings? Take it from there, Mike.
Well, thank you, Steve, and both you guys, thank you for the wonderful introduction. I couldn't ask for more. You guys are awesome. And for everybody out there, we do like to cut it up and have fun and figure out where the market's going. But it's not just academic. It's, fun to arm wrestle about the indicators you use, but it's pretty darn important to know whether you're a money manager or just a regular investor or an advisor who runs money. And it's a very different situation when you're in year one of a bull market and have a long runway ahead of you, or year four of a bear bull market with very little runway left. And so just when this bull market started, I'd say probably a month or two ago, I started calling some folks out there, and there's probably 5 or 6 folks whose work I really, truly respect. And I'm not going to name names here, but there are a lot of folks you've heard of in the past, and you guys are absolutely on that list. And as fate would have it, I got to you guys last. And the first 5 people I had called all told me unequivocally, oh yeah, this is year 4 of a bull market. We haven't reset squat. This is just an old, tired bull market, maybe a little bit of a gasp left, and who not much further to go. The only exception to that was Katie Stockton, who I will name names on because I love her so much. We used to work together.
Is that like cheating? Is that cheating though? Because you guys used to work together for so long?
Yeah, kind of, though we disagree every once in a while. We did an MTA event in 2009, and we were the only 2 people in the room who thought it was a new cycle. And it was funny because we showed the same charts. But I digress. It's cheating a little bit. But she said, I don't care whether it's year 1 or year 4. The tape looks healthy. And I said, Katie, that's a good answer. So
that's my answer, right?
Yeah,
like I do care, but like that at the end of the day is what I'll lean back on.
Right. And so that's kind of why we do this and why we try and figure out whether you're in a bull market or a bear market. And so the quick answer is all my friends whose work I know and respect said, yeah, it's year 4 of a bull market. Don't get too excited. And then I called Strazza, and he's the only one who agreed with me that we're in year 1 of a new bull market. And I think we are. Now, again, it remains to be seen whether we have 2 more good years, because as you, JC, and Katie say, as long as the tape's healthy, I'm okay. But I like to know a little bit more where you are in the cycle, and I think it is year 1.
All right,
has your opinion changed at all? On that view over the past couple of weeks, just with some of the selling pressure and volatility that's kind of entered the market?
It hasn't, Steve, and I don't think it will unless let me go to the chart and I'll show you exactly what I look for. Yeah, and JC, you can walk us through this. But on this chart that's a little bit busy on this page, I have 3 really primary indicators. The purple dotted line under the S&P 500 is that 40-week moving average or 200-day moving average. A lot of folks use that as a simple indicator of bull or bear market, and it works pretty darn fine. The blue line
so
just below the
purple line here. So just hold on. So just for the folks at home trying to keep up with what's happening in this chart. So you got a purple line here marked 40. So this is the 40-week moving average, which is essentially 200 days, a 200-day moving average, 40-week moving average, right?
And it's a pretty good indicator. Yeah, there's a whipsaw there in 23 and, maybe some others we can find. But in general, as long as you just assume you're in a bull market when you're above that, you're in pretty darn good shape.
You're probably not in a bear market if you're above the 200-day moving average.
Yeah, exactly.
Right.
Exactly.
Okay.
Below
the
that,
oscillator,
interestingly, is the distance the S&P is above the 200-day or below the 200-day. And that's something I use for an overbought, oversold indicator. Again, it's not really precise, but it tells you when the market is a little bit extended, which is where I think we are now. We're 11% above the 200-day. Maybe it is time for a correction, as that old grumpy bear Steve mentioned. No, I'm kidding. But I could see a correction here and some weak breadth over the next couple weeks or a month, but it would take a lot to damage the overall primary trend, in my view, which, Vanna, you can go to the bottom pane and see.
That's me, Vanna White. I'm the Vanna White of technical analysis.
Exactly, and way more handsome than she is pretty. But that purple line on the bottom is the percentage of issues or stocks on the New York Stock Exchange that are above that purple line or that 200-day moving average. And that's the really and truly the primary indicator I use for bull and bear markets.
You see, Strazza, how he uses the New York Stock Exchange. You see how he does that there. Do you know anybody else who does that?
No, I love Mike's charts. This is so good.
It's about to be the Texas Stock Exchange that we're going to start using,
Whatever.
Can you?
As long as it's as good as the New York Stock Exchange, it can be anywhere, whatever. Have you been to the New York Stock Exchange? It's a lovely building, but there's not much going on.
Not in years. And I can say I'm a proud Texan, but I wasn't born and raised here. I've only been here about 10 years, but everything's following me. It's great.
All right.
Mike, explain to people.
Bottom indicator is what I use as a primary indicator for bull and bear trends. And the key number there is 40, which I have highlighted in blue. When you're above 40, it's usually a bull market, and that's where I put those green vertical lines. So again, like the 40 week itself, it's not perfect. When you go below the 40 week, I have a vertical red line, or go below 40% on that indicator. So it's not perfect, but again, if you don't fight the tape when you're on the side of the bulls or the bears, you usually have a better result than the other way around. Now, the last thing I want to mention about that bottom indicator is when it gets below 20, it's usually a sufficient washout to call it a bear market. Now, again, a lot of people have different definitions. Some people say 20% off the top. Our good friend Ari Wald says he uses an 18-month low. So if the market or the index makes a lowest or lower low over the last 18 months and it's at a low point, that's a bear market. So he incorporates a little bit more time than price. I use breadth, which is that purple line. And when it gets below 20, usually you're in a bear market. And so this is why I mentioned.
I'm with you on this one, by the way, Mike. And, Craig Johnson thinks about it in a similar way, too. I forget. We've had this conversation a few times, but he fits somewhere between in the you and me category here. For me, when you get below 15 and then get back above 200, you buy it on the way up. Woo-wee.
Yeah. So Mike, the green dotted lines here labeled spring day are ultimately the initiation readings.
Yes.
And that's when the percentage above the 200-day returns back above that magical 40% line.
Yeah. Now, again, we've mentioned a couple of technicians here. Ari Wald likes to use 60. I think if you use 60, you're subject to fewer whipsaws than I get. You're going to be a little bit later. But what we do, you guys, as you know, and I'm sure a lot of your watchers know, it's just as much art as science. It takes interpretation. If you're willing to, as you said, JC, buy when you cut back above 20, great. You're going to get more of the returns. You're going to get whipsawed more than the guy who buys above 40 or above 60. But you watch the market enough and you're nimble enough to put a stop loss on stuff. So tools are tools. You really have to figure out how to use them to your needs, whether, again, you're a swing trader or you run a portfolio of a mutual fund or whatever. But the tools work. You just got to fit them to your style.
And then, again, Mike, where you have it labeled break, where the red dotted vertical lines are drawn, that's based on the price oscillator doing what?
Usually going through support. On the oscillator or on the S&P 500? Because the S&P 500 in 25, I put the break there, but that was just a break of support. But again, you break support, you break a 200-day, and you see the purple line break 40. You probably need to, go to cash or something.
Mike, let me ask you this, a little bit off topic, because we're talking about breadth and cycles here specifically, but I can't help think about where sentiment fits within the framework of a breadth and market trend, cycle. Because from extremes and pessimism, is where new cycles are born. And if we're going to have a conversation about this year being year one of a cycle, it's got to start with washout sentiment levels that you had this spring, no?
It does, JC, and you know a lot more about market history and sentiment than I do, but sentiment is definitely a part of technical analysis. People use the VIX all the time to identify both tops and bottoms. I have been less successful on that, but I do agree with you. I can use the VIX to identify bottoms in the market. Some people are better and use it to identify tops when the VIX goes to sleep. But the way I use the VIX
Better
is
for the bottoms.
yeah, if you see a spike in the VIX and it starts coming back, now what does coming back mean? There's your judgment. I use a 5-day simple moving average on the VIX. And when the VIX cuts below its 5-day simple moving average, the panic's over. Now, sometimes you get a second wave or a bang and a whimper, but any type of indicator that is not on a 0 to 100 scale, like a percentage or a stochastic, is difficult to use in another way because the VIX at 25 may be high. Well, maybe at 35 is high. Well, 60 is really high, except during the global financial crisis where it went to 80, right? So when you don't have that 0 to 100 scale, you have to use some sort of trailing moving average or parabolic to figure out when the dang thing is done going up and actually on its way back down.
All right, so let me just reiterate to the folks listening at home that what Mike Hurley's saying is that there's a lot of data that he follows, who we all consider Mike Hurley to be the man at exactly this, and what the man at exactly this is suggesting is that this is year one of a bull market, not year 3 or 4, year one. We are just getting started. Now, I want to talk about the targets and what the implications of that mean, but I want to give Steve Strazza a chance. Is there anything you want to add? How do you feel about the sentiment with the breadth together?
No, I think Mike's doing a great job breaking it down. I have nothing to add. I want to talk about fall days here in a little bit.
I can't have a conversation about the cycles, without, seeing that sentiment reset. And, I think we saw it, so you're looking at it from a breadth standpoint. And I'm not disagreeing with any of that. I see the same thing. I'm totally with you. I think there's more to that. And I hadn't thought about it. I thought about it more as just like a general sentiment reset and the market can go higher, not so much zooming out and thinking about it like, wow, what are the bigger implications here? And from a breadth washout standpoint, I think that's really interesting. So if you're an investor listening at home, Mike, what does this mean? I mean, how high can we go?
It's really interesting, JC, and thank you for showing the second chart. And I guess before I get there, I was a little academic on my use of the VIX because, again, the three of us like to help people and, talk about tools and show folks what we do. But getting back to where we were in March and April, I think that was a sentiment washout. And it was almost like COVID. It was something that hit the market as an externality. Nobody expected the tariff tantrum. And all of a sudden, man, the herd ran. It was like shooting a bullet or a gun in the air and spooked the herd. And that really was a sentiment washout, I believe, in February and April. And you could see it in the VIX.
Yeah.
Okay. So moving on to the second chart. This one's really nerdy, which is why I know you guys like it. But about 10 years ago now, I came up with this because I was arm wrestling with one of the guys at work who was a fundamental guy. And I was bullish when we were coming off the 15 lows. And he's like, nothing can drive the market higher. What do you think's going to drive the market? I'm like, I don't know. Technicians never know what the cause is. Right. Well, how high can it go? And I said, I don't know. Well, I didn't like the fact that I didn't know. And you never really know. But it turned me into the books. And I started looking at all the cycles since 1932, the bottom in 1932. And I consider that kind of the modern era. Now, this table on the left shows the low and the high of the cycle by my definition. Again, if you ask Ari Wald his definition of the cycles, he's not going to come up with the same table. For number one, he doesn't consider 2011 a reset. I do. But he catches 94 when a lot of people don't, and I do. My point is, I look for a bottom about every 4 years because of that 4-year stock market cycle. And if you do an average of the rally after a reset, it usually lasts 3 years and 100%. Or as you can see in the brown row of the table, 98% is the average bull market since 1932. And that's where I have the X on that chart to the right. So if you think we're in year one right now, you can see the little green arrow at the bottom in April of 25. You add 3 years and 100% to that, and you're going to get 95.79 in the S&P 500 on March of 28, sometime in March of 28. And
This is
that's
a great chart.
From
great
here.
chart to like visualize different years and what those cycles did. This is fantastic.
And so that's the point, JC, is each of those dots is an exact,
Analog.
play. Yeah, an analog to where you would fit if you had an exact repeat. Now, of course, there are no exact repeats, but it looks to me like a shotgun pattern, and that's why I call this my shotgun chart, is because those are all the 23 cycles, and you do have a pretty darn good average in there, regardless of whether you're in a secular bear, secular bull, and that's what the red and green colors are. So when you're in a secular bull, the declines are less, but the rallies are the same. And when you're in a secular bear, the rallies are the same, but the declines are more stiff. So it was just an interesting study I came up with. And to answer the guy's question, he says, where do you think the market can go? I said, well, here's where I think it would go if it was an average bull. And it has been a pretty good tool to use, and I've used it since 2015. And you'd be surprised at some of the market cycles, how you've look at the middle of the yellow circle, right? See the 22?
Yeah.
That was the top in 22. So if you tag and did this, shotgun chart to the bottom in 2022, it called it darn near to the penny, or, not the penny, but pretty darn close to right.
The closest
in
ever.
the middle. Yeah, it was almost an average bull market in time and price. Now, not others have been so close, but you get the idea.
This is fantastic.
S&P 10,000. Let's go, baby.
Wouldn't that be something?
Dude, right, S&P 10,000. That's the name of the boat.
All right, hold on. I'm going to push back. I'm going to play a little devil's advocate. Let's flip it back to the next chart and talk about, what would invalidate this thesis at this point. I know, Mike, you pay a lot of attention to price for confirmation or to support your thesis here. And back during, I guess, the last cycle now, right? Earlier this year, we had this little top that you have marked up in the, upper right hand corner of this chart. And it was a nice little tactical top, and it led to a big drawdown. You have the break labeled right there. When I look at a chart of the S&P 500 right now, I can draw a very similar little top to the one that resolved lower back in the first week of March. Are you monitoring that? Are you watching like the 650 level in the S&P 500? And do you think that would invalidate what you're seeing and saying here?
I think it's going to take more than that. And the only time a little top really came undone on us, and I love mentioning it because the three of us caught it. And I don't know if you guys remember it, but I remember it. We did a webinar for All-Star Charts in February of 20.
Yep.
And we were all real nervous when that 50-day collapsed. And we were kind of looking at each other like, wow, I didn't expect that 50-day to go so fast. And that market came undone quickly. Now, I believe that webinar that you speak of, we referred to at the time as happy hour with traders.
Yeah, it was five of us.
It was a little more lighthearted than Mike makes it sound, like a bunch of, depressed. We were short, so we were pretty excited about it. We didn't know the world was going into a pandemic or whatever. We were just...
But when we saw that 50-day break, our eyes got a little bit big, like, whoa, wow, that was a little weaker than we thought.
Wasn't Thrasher on that too? Thrasher was on there too.
Yes.
Yep.
Nice.
But that was the lesson, is listen to the market to be your guide. Now, what would concern me is if the purple line at the bottom fell through 40, and you can see it did that in late 23. And the last cycle, what was unique about the last cycle is you had a crummy first year and a great, second year. And usually it's the other way around. So what would concern me is if you have a little spike down like you did toward the end of 23 that takes the S&P below its 40 week and the purple line below 40%. And we're a long way from that, but that's when I would get more nervous.
Yep. No, I love it. Great.
All right. So guys, just to circle back, Mike Hurley calling up Steve Strazza, calling up a bunch of smart technicians, asking them what they think about the idea that this is year one of a bull market, not year 3, year 4, like many people think. And, some people push back, but, the more and more I'm thinking about it, especially when you add the element of psychology and sentiment, hitting those washout levels and, the market participation. And for me, I'll add the global participation around the market. You want to talk about positive breadth. I mean, you're not going to see better positive breadth data anywhere except when you look around the world. I mean, to me, that is the most positive. So, big time targets, 9,000, 10,000 potentially for the S&P in the coming years. To me, as an investor, what that means is that there are likely to be many opportunities to profit throughout that time period, right? So what I'm looking for are ideas. I'm looking for opportunities to make money from the long side across a variety of different sectors. Sector rotation is the lifeblood of a bull market. We see it every bull market. I would fully expect to see a lot of that, and a rising tide lifts all boats, so to speak, when there's certain leaders during certain times of the coming years, other leaders during others. That constant idea flow is really what I'm looking for in order to benefit from from what Mike thinks is going to happen in the coming years. And I find it very difficult to disagree.
And that's the point, JC, is you want to be of the right mindset and on the right side of the tape. And to short this thing all the way up because you think it's expensive or you think the geopolitical uncertainty is a problem, that's not the way to approach this market. And it's fun to talk about levels like 9,000 and 10,000, and I'm sure we'll raise a glass on another trader happy hour if and when we get there.
Yeah.
But the perspective and the mindset is what's important. And last point I want to make, I know you do a lot of work on market sentiment. You've already asked me a couple questions on it. Well, what do you think it says about the sentiment when a lot of professionals who you and I and Steve know and respect aren't bought in yet? That's demand waiting to happen. Okay, do they get bullish when you get through 7,000? When do they start believing it? But right now, sentiment is far from exuberant on this bull market.
It's not just market professionals. I think, the whole investing world, I think is planning to be in the later innings of an existing cycle right now, not to be in the early stages of a new one. So,
and last comparison I want to make. If you look at this chart here, you can see kind of a fast bull market. It looks maybe a little bit like COVID, a little bit of a shelf, maybe halfway down, and then a bounce and a test.
It was a V. In a lot of ways, it was a V just like COVID, right?
It was. But if you look at the length and depth of the market, now the base wasn't as wide. But some of our good friends at Strategist the other day did a comparison to this market compared to 98, and it looks just like the 1998 decline, which was, again, sentiment, scary, long-term capital management was going to crush the world. We had the Asian contagion, and then all of a sudden, these guys with 50-pound heads who, write textbooks on options contracts, all of a sudden we're about ready to blow up the world. So that bear market was a lot like the long-term capital market.
And everybody thought that 99 was going to be a terrible year. Time magazine covers, Newsweek covers talking about the end of the boom. 99 was a great year. 99 was a great year. So guys, I hope you enjoyed this. For me personally, and Strazza for sure, we're big fans of Mr. Mike Hurley. Now I believe you at home are also, right? Because now you're seeing the man at work. Mike Hurley, very bullish, 9,000, 10,000 S&P next couple of years. I mean, no arguments here. Let's see it, baby. Let's see it. Thank you, everybody, for joining us, and we'll catch you on the next one. Adios.
Thanks, Mike.
Thanks, Mike.
My pleasure.